Welcome to the Financial Freedom Guy podcast. I'm here with my friend Roger, and Roger is big background, MIT, lawyer, technology, engineer, and doing something very strategic with businesses about growth. And so we're going to unpack some of how can you strategically grow a business, gaining the wisdom that Roger acquired from I don't know how many deals, Roger, but I guess you can tell us. Roger, how would you introduce yourself?
Well, I introduced myself as an acquisition entrepreneur. So I got a pretty broad background. It's everything from business, law, and technology. But I'm primarily focused on helping businesses to grow and to find exits.
Okay, so that's a new term for most of us. So what does acquisition entrepreneur mean?
So it's kind of a combination between mergers and acquisition and starting a business or entrepreneurship. And it's really the best of both worlds from my perspective. So it's really buying an existing business rather than starting one from scratch. And the key is really to identify the right business with the potential, stepping in an operational role and actively growing the business using your skills and experiences. But you're starting from, if you will, second base instead of, starting from, batting.
Yeah. What think about so you take somebody who may or may not have owned a business before. Is that right?
uh, when you say the acquisition entrepreneur may or may not have owned the business, yeah. I mean, I think a good example of that is really how I got into it. Um, the opportunity is that you don't have to start a business from scratch. You don't have to have all of the skills necessary to build a business or build a product. You really just need to take your skills, your experiences, and apply them to a business in a way that can add value. So in my case, my first acquisition was a company called FCR Software, and I had spent most of my career really as a lawyer, helping businesses raise capital, license technology, and to do other things that more on the outside. I got this opportunity to really take over a company called FCR Software, and we had some basic networking protocol stacks. Those are really just software that allowed computers to communicate with the internet. And the fellow who built the product, this was during the heady days of the internet, so things were really taking off. The person who built the product, he was going off to do another company, and he asked me to take over the business, and I said, great. It was an opportunity for me to transition to the business, to get an equal share or equal ownership of the company, to acquire a significant stake without having to put money up and without having to start things from scratch. So I jumped in, and in that case, what we did was we built a product that allowed businesses who wanted to connect to the internet in the early days. You could both work from home and access the internet, but you could also access your computer server at your office. So it was really the first time. It was long before COVID, long before everybody
Yeah.
started working from home. It was the first enabling technology to be able to work from home and access both the office and the internet. And so that was kind of fun. We built that product for the Macintosh. We had the first one out there. It taught me a lot about customers. It taught me a lot about marketing and sales and financials and building products that really fit, the customer need. It's a great example, pretty much, of how you can transition from a professional career, or you can transition from, just being in the corporate world to, owning a business and having that entrepreneurial experience.
Yeah, so let's break that down a little more. So you had a Macintosh that does go back a few minutes, right? And so okay, so you had the options. In your case, you're seeing businesses, you're seeing business deals. You have an experience from a lawyer standpoint. What are the pros and cons of acquiring a business that's already operating versus just starting from scratch with your vision?
The advantage is that the product's already tested in the marketplace. You already know that there are customers that who have a need and who want to be able to use the product And so that gives you a really big leg up. You don't have to test whether or not there is a valid need. You don't have to test whether or not somebody will actually buy your product.
And that's huge. Okay, from experience, a lot of business owners, they have the vision. I was talking to one business owner 2 days ago, and potential business owner, and it's like 3 years and it's still on the drawing board, still trying to figure things out, haven't gone to market. And so with your approach, you buy something that's already moving and just use your unique skills to optimize it. Is that kind of what their approach is?
Yeah, that's exactly it. So for any kind of a company that you want to step in, you want to be able to leverage your background, your experience to help the company grow. In my case, I had a lot of experience licensing technology, and so we could grow the business either B2B by licensing technology, or B2C by selling, a finished product to end users. It was much faster and much more profitable to sell B2B, and that leveraged my background, which was licensing technology. So we actually took the protocol, the networking protocol stack that we had, and we licensed it to other companies.
Okay, so they kind of created like a resale environment, something like that.
Yeah, it's tapping into an existing sort of distribution network.
Yeah.
So in our case, we had figured out how to get computers to communicate with each other. And so that's what's called a networking protocol stack. And what we did is we licensed it to other businesses that wanted to take that software and put it into their hardware. So then they could sell it to their customers and allow other customers to be able to make the same kind of communications link.
Yeah, pretty strategic. Instead of a one-to-one sales, you got a one-to-many thing going on. Do you feel comfortable talking about the numbers, like when you bought the business, what it was doing financially, then where you took it?
Yeah. So when I took over the business, and in this case, it was a no money down deal, just because I knew the owner. He wanted to move on, and what we did was just agree to share equal ownership. Um, they had some initial sales with customers, but they hadn't really developed it. So they might have been doing, $50,000, $100,000 type of sales for a year. So when I took over, we then grew it to about 10 times that. We had about $500,000 in mostly licensing revenues, and we used the end user products to really test and debug a lot of the software.
Yeah, that's
Um,
10x. That's a good outcome.
Yeah, it was great, and it was cash flow positive, so almost from scratch. And that's the big advantage of licensing instead of selling directly to the consumer. So if we were selling directly to the consumer, we might sell one copy of a program and for $75, and that would allow that person to connect to the internet as dial-up software. But if we sold it to a company, and we would sell to big companies like Lockheed Martin, and they would have like 25,000 users, we could sell it at a fraction of the cost, but we're selling it in bulk or in volume. So
Yeah.
the size of the order might be $10,000, $20,000, and that was much more lucrative, much more cost effective in terms of our time, and it was much faster to grow the company.
Yeah. Roger, it sounds like uniqueness played a big role. Like you had this unique technology that could plug into other people's platform or technology, and then that you could just amplify the level of activity.
Yeah, it was unique because we were the first dial-up software for the Macintosh. They had dial-up on the PC, but and they had other programs, but they weren't integrated with the Macintosh so that you could access your Office network. So it was unique in that we were the first ones. And later, Apple built it into the product. Every computer you get today automatically has connection software built into it. No one even thinks of it. But back then, you had to buy it. So the uniqueness is important because if you don't stay ahead of the curve in terms of technology, eventually your product life cycle runs out, and you need the next product. Otherwise, the business starts to wind down. And that's actually one of the things that I learned from that experience is that if you don't stay ahead of the technology curve, eventually it's going to come up, and bite you because there's always a next generation of products around the corner, particularly in that field.
Yeah, technology moves so much faster than most industries, where you got to know the life cycle and have, there's early, there's cash, get the cash cow, and then what's your next rising star. I think that's the Boston consultants look at it, but yeah, it's moving. That world's moving a lot faster with all the the technology space, the AI and blockchain. When you're thinking about looking for a business to acquire, where do you begin?
Yeah, a lot of ways to go. There isn't like one right way to do it, but the best way is to really start with your personal network. People who know, like, and trust you are going to be the easiest to refer you into or introduce you to a company. And those can be, people who are in the industry already. It can be other acquisition entrepreneurs. Those are other people out there looking for deals, and it may not be the right deal for them or the right company for them. And so they'll bring you in and maybe just turn it over to you, or bring you in as a JV, as a partner. So networking is a big part of getting, I would say, the best deals. But there are lots of other ways. You can go to business brokers. You can go to online marketplaces. There's Biz Buy Sell, and you can look at some of the deals that are listed. They tend to be, higher price, and sometimes, more picked over. So we tend to have a bias towards finding companies that are off market, that really, it's word of mouth that introduces you to a business owner. You get to know the business owner and what they're really trying to do. You try to figure out if they're interested in selling, or if they're really just interested in growing the business, and just improving its value before they sell. And we can play a lot of different roles in helping business owners.
Yeah, so your trusted network first, and then listings next. I would think CPAs and lawyers would be a great go-to trusted relationship to see if they know somebody that
Yeah,
matches
well,
the criteria.
they are. I mean, professionals do know a lot of businesses, and particularly CPAs, accountants. They often, know exactly when a business owner wants to sell. I actually think accountants and CPAs are, and financial advisors are probably the best source, like you, for finding businesses. Um, because they have, one-on-one personal relationship with the CEO, or owners, and they're going to be in the best position to know when, they need some help to go to the next level, when they need some help, or in positioning the business for sale. So that's definitely a good one. As a retired lawyer, I can tell you, lawyers sometimes are a good lead, but they tend to be a little bit more shy at introducing their companies to other people.
Yeah, why do you think that is? I saw the same thing. Lawyers, they don't they like introduction, but they don't give as many. Yeah.
Yeah, and it's because lawyers are, a sort of an unusual breed. Lawyers tend to be conservative. I mean, lawyers, their job oftentimes is to protect their businesses and their clients. And so they tend to err on the side of being more conservative, more protective, and less likely to make introductions, because a lawyer's trained at 1,000 things that can go wrong. So they get that in their head. And so they think, well, if I don't know them very well and the relationship doesn't work out, they'll blame me, or, maybe it won't be the right fit, or, maybe it'll take too much time. And time is the other factor. Is a lot of lawyers are paid such a high hourly rate that they don't think it's worth their time to make the introductions, when they could just be, working on another client project.
Yeah, so they got the risk of something going wrong too much in their head, huh?
Yeah,
To
that's
make
a good way to summarize it.
make more connections versus fewer. Okay. But they're definitely the CPA and the lawyers are like the number one, number two trusted advisor, for many business owners. So okay, kind of thinking through things here. It, it definitely makes sense because buying a business, it's so much is based on trust. Because I've seen otherwise, the seller at some point they get into a pissing contest, about what's good and what's not good. But if there's a relationship, either direct or one removed, it helps. It kind of helps facilitate enough trust to take that step. So So I can see the wisdom, Roger, what you're talking
And
about.
that's a key part. I mean, what has been your experience? I mean, in terms of being a trusted advisor, you know and work with the company, and one of the reasons why you're a good source of referrals is because the business owner has worked with you for a certain number of years. They know that you know their financials inside and out, and you have a sense of what their business is like, and so they trust your recommendations. Has that been your experience as well?
It has been because, like, from a growth CFO standpoint, before we approach potential sellers of a business, we really know what the business can use either to amplify a benefit they have or cover a gap. And so then we know the business that well. We know that how cash flows moves through the business. So when we approach a buyer, we can validate pretty pretty seriously. Depending on how we want to structure it, we have the money, we have the need, and you're in the ballpark, and so it just gives a lot of credibility to the whole experience. And by having somebody in between the business owners, it allows the business owners to stay at arm's length, so they don't get into, because it's really, especially for a business owner who's the founder of their business, there's a lot of this is my baby kind of thing tied up into it. So if somebody comes in and they see things, they see the business more black and white than what the founder might see. I've seen very roughly 3 out of 4 deals can start to go sideways pretty fast because of that just disconnect of how the buyer is seeing things differently, more about what the business can do capacity wise for financial outcomes, whereas the founder, I mean, had the vision, that kind of thing. So by having somebody in between that understands both, it can go a long ways to get into a really good option for both parties to get either most of what they want or all of what they want. So
And
yeah.
it's nice to have a second pair of eyes, an outside perspective, taking a look at the business. Uh, and for the financial perspective, if there's anything that can go wrong in a deal, the fastest, it's the financials. If the financials, if there's a problem with it, or people don't trust the financials, nothing will kill a deal faster. So I think that tends to be the place to start with most businesses. You may love the company, say, "Oh, I'd love to take over this company," or "I'd love to, be in this industry." But if the financials are not in good shape, and you don't trust that what you think is the business is actually the business, then that's usually a deal I'd walk away from. So um, that's really the place to start, with trust on both sides, both from the seller's perspective in terms of knowing people that, or meeting potential buyers that are recommended by a financial advisor, but also from the buyer's perspective, having some confidence, because you know a lot of sellers, they might work in a business for like 10 years. They know the business inside and out. But from the buyer's perspective, um, even if you're an acquisition entrepreneur, you're coming at it from the buyer's perspective. You don't have the benefit of being in the business for 10 years. You don't know where the bodies are buried. So you
Yeah.
start with the financials, and then you have to try and read between the lines. And this might be interesting to get your thoughts on, in particular. So when I look at the financials, I'm trying to figure out what's the story behind it. What are they telling me? But probably I'm asking more, what are they not telling me? And are there footnotes that give me some insight into where some of these numbers are, or are they more just sort of a printout from QuickBooks, that where you're trying to guess as to what's really going on? What's been your your experience there?
Yeah, it's I'm glad you brought up the financial, the actual numbers, the financial statements, because a lot of companies, even good sized companies doing 30, 40, 50 million, they don't use their monthly financials like every month to gauge on what's going on. And if they're not using, like you use the term, using that number story, where we at, where do we want to be, what's the variance, and to inform where to take action. If they're not using the financials every month, they don't have that feedback loop going back into accounting and say, no, I need to see this, I need to see it this way, I need to see the expense or revenue a certain way. Invariably there's errors. If they're not being reviewed consistently every month, we call it the habits of profitability. The second one is using the monthly financial like a scorecard. If they're not doing that, invariably the financials are going to be accurate, maybe materially inaccurate, and that's when somebody wants to do a deal, buyer or seller, and then come to some understanding of value and what the structure may look like, cash, non-cash, whatever it is. And the minute the buyer is actually looking at the financials and there's some differences, material differences, it falls apart fast.
Yeah, well, so I've got a good example of that. So a few weeks ago, maybe it was 2 months ago, actually, I was looking at an online education company, and I think they said the business was doing like $1 million in revenue. I said, great. So can we take a look at the financials? Well, they didn't send us real financials. They sent us a tax return. And, with the tax return, it's a corporation. You can see what kind of looks like financials. But when you started to dig into the numbers, it was like, I don't really understand, what this business is. So in this case, the revenue showed the $1 million in revenues, but it showed profit of like $600,000, and the taxes return said there was no taxes due. And I tried to understand, like, how do you not pay taxes? And I thought you were only making $20,000 a month, which would be $240,000. How come this is showing like $600,000 in profit? And you'd think that would be sort of a simple answer, but we went back and forth, and it turns out that there was a subsidiary in Israel, and that the subsidiary had all kinds of expenses, but they wouldn't show us the financials for the subsidiary. They said, oh, you don't have to worry about it. It's just a subsidiary. But we don't really have a clear financial picture. And the more I kept asking about the financial information, the more it was pretty clear that they didn't want us to have a clear financial picture, but they would never admit it. I finally gave them a detailed due diligence list of financial information that we needed, and then they just went away. So, but they were expecting us to just write a check without really understanding the financial picture.
And Roger, those are great examples where just by focusing, before a buyer invests time and money looking at the assets and the customers and location, all that kind of stuff, look at the financials first and the way you're describing. Then right there, you can make a go or no go decision. Whether you want to take the next step or not. Here's a couple of things to think about. I remember we were working with a company, warehouses, logistics, all this kind of stuff, and they were acquiring other companies to grow strategically into new territories, new marketplaces. And I remember one of the potential targets. We looked at the financials. One of the financials that's often ignored is the statement of cash flow, because it's kind of hard to read. It doesn't make sense until you do it consistently. And you can see the company, wasn't doing any, for years, they hadn't made any investment in the new equipment, right? You can literally see it on that section of the statement of cash flow. So right there, you start to, doesn't tell you, the number story, doesn't tell you the final answer, but it tells me, I think they've been running their operation, their manufacturing operation at overcapacity in order to drive up revenue and profitability. And maybe they're not doing all the maintenance they should be doing. They're definitely not replacing the equipment. You can look at the years of not replacing the equipment, which as a buyer, I at least have a theory or a hunch that they're running the machines in the ground to drive up their financial numbers and utilization and everything else, so they get a higher valuation on that. And the minute I come in, it's like, man, I need more money in order to replace equipment and do maintenance and do this and do that. So just by looking at the financials before investing time in examining the actual operations and assets, you can say, get a pretty good idea on whether you want to take the next step or not.
Yeah, absolutely. I think of it as trying to match the financials with the physical reality. So it's like, equipment, that's a good, example of the problem, which is, have they been replacing the equipment? Are they maintaining it? Is it old equipment or is it beat up stuff and you can look at it and see how much of it has been depreciated. And that tells you something about whether or not it's been replaced. And but you have to have to take the financials and then see if you can match it up with the physical reality. So I like to actually do the drive-by. I actually like to look at the equipment, and it tells you so many things that are in the financial that you don't understand until you see the physical reality. Like, okay, that equipment, it has to sit someplace. So if it's trucks, where do they get housed overnight? How much land do you need? Does that mean that, real estate should be part of the deal? If the seller owns it. And so you start with the numbers and it starts giving you a list of questions that you then want to match up with the reality.
Yeah, that's a great approach. And okay, let's take it a step further. So you look at the internal data, internal financials. It's starting to point, how does it match up to reality? Another useful step is do the benchmark with external data. Like there's databases of the same database of financial that banks use. Banks are pretty conservative. They like accurate information. So if you use the bank's database to do benchmarks against a potential acquisition target, you start the gaps, the differences, better or worse, left or right. It starts telling you where to go look more to understand about the business and that operational reality. So, but those habits you're describing, those approach, you can see, it's unreal how much you can see in a very short period of time.
Yeah. Yeah. And I think the best business owners or the business acquirers are the ones who ask lots of questions. They're the ones who want to understand the numbers. They're not afraid of it. They want to understand the customers and the market. And it's just a sort of a progressive understanding of how the business works. Every time you learn one piece of information, it'll raise probably one or two more questions, and you just keep following it until you really understand it. What you're trying to do is, as a buyer, you're trying to know the business as well as the seller who's been working in the business for 10, 20 years. And you have to move quickly, because a lot of times these deals don't last more than 60, 90 days.
Yeah, you can move. There's something about speed. The more it lingers, the more it starts falling through the cracks. So how do you decide what type of business you want to acquire?
It's got to be the right fit. I think of it as like putting together the pieces of a puzzle. Um, when the right pieces go in place, and when they don't. And if you're not looking for the right pieces, acquiring the wrong business is not necessarily a good deal for either the buyer or the seller. So for me, some of the right pieces are finding businesses that I can leverage my own talent, that I can bring something to the table. It's finding businesses where I think there's something in the market or an opportunity that hasn't been fully leveraged. So there's an opportunity to grow the business. And there may be circumstances, you have to have a seller who's motivated, ready to sell, and one who's willing to sell at a fair price. Too often business owners start with whatever number, the highest number they've heard during the height or the peak season for when people are buying businesses, at the highest possible multiple. And that's a great time to sell if you know when the peak is coming, and if you are in a position where your business is ready. But it helps to have a seller who understands where the market is today. And to do that, they have to be educated about both the market and really the valuations. So looking for a business where the seller is reasonable and willing to make a deal and is motivated to make a deal.
Yeah, and that could, I would imagine that could be a pretty big hurdle, because people are all hyped up about these unicorns type exits. And a lot of businesses have dependencies where they're dependent on the founder, they're dependent on a key customer, that they haven't worked out the playbooks. So when you approach people, like, how many people, like, are most business owners, are they in a realistic zone of what the value could be and how it could be structured? Or are you finding like it's not even worth the second phone call? What are you saying?
Yeah, I mean, I think you have to meet people where they are, and really everything about the business is the business owner. It's their dream, it's their baby, they know the customers. And so you kind of meet people where they are, which means if they are interested and motivated to sell or to make a deal, then you work with that. And if not, you try to demonstrate the value, but you can't push people into things that don't really fit or don't really make sense to them or they're not ready to do. So from an acquisition entrepreneur's perspective, our goal is really to generate as many opportunities as we can, um, because we don't know which ones are going to be the right fit. It's again comes back to that sort of puzzle building analogy. You can have 100 pieces on the table, but you're sorting them out by color, by pattern, by shape, and you're looking for the one or two pieces that fit into the area of the puzzle that you're working on at any given time. And it's kind of the same thing. We might have 5, 10 active conversations with business owners that we think could be a good fit, but we're really still trying to put all the pieces together and make sure the timing is right, and then close whichever deal wants to happen. And by doing that, it puts less pressure on, I think, the buyers and the sellers, because everybody's just trying to do what's really a good deal for themselves. And ideally a good deal for the company. You want a situation where the business is going to be successful. But it also makes it easier to avoid what they call deal heat. So what happens if you only have one or two deals and you really fall in love with the company is then you get this sort of feeling that you have to make it work. And that puts too much pressure on the deal, and it's more likely to blow it up than it is to make it successful.
Yeah, I can see it almost like your car shopping, and all of a sudden this is the only car like that, right? Like there's not
Yeah.
thousands of them, kind of thing. Yeah, interesting. So, okay, okay. So, what advice would you give somebody? It's first time they're doing a business acquisition. They have a professional track record, that kind of thing. What advice would you give that person who's looking at making their first entrepreneurial acquisition to get into business ownership? What would
Yeah.
you advise them?
First, I'd start with exploring possibilities. I would start with your network, let people know that you're interested in acquiring a business, and I'd get to know as many business owners as possible, just so that you understand sort of the way they think and what they might be looking for, and you're comfortable with those conversations. Once you're comfortable with the conversation, it makes it easier to build rapport with business owners, and that's probably the most important thing. Very few people want to get into a deal to sell what may be the biggest asset that they own, that may be something that they put in passion and effort in for a good portion of their professional life. They would be reluctant to turn it over to somebody they don't really know, like, or trust.
Yeah.
So developing that rapport is key, and you can't do that without getting to know business owners in general, but that particular business owner, and then being sort of respectful about the process of trying to understand what their goals are, what kind of a transition they want, how important different aspects of the business are to them, and what they want to see happen, whether it's they want to retain employees or they want to keep the product, designed in a certain way, or whether they just have, some other uh, priorities or preferences that, you try and accommodate, as much as possible.
Yeah, so you really want to figure out what they want, what they need, what they care about, and then match the deal to that.
Yeah.
What,
And
what,
then
what
and then
uh,
I'd focus on value as opposed to, the terms of the deal. What's the value you bring to the table? What's the value to the business owner? How does it make their life, their transition easier? You want to be creative, because a lot of things are not just a question of agreeing on a price and a number and then writing a check. It's trying to figure out how to solve the little things that often become big things. And it's having a certain amount of patience to go through the process, to be willing to take on the next sort of issue that comes up, because there'll always be a last minute issue that somebody needs to solve, and people can get frustrated. So as long as you sort of embrace the problem solving challenge, you'll do well.
Yeah, that makes a lot of sense. And just to kind of build on this a little bit, we're talking about somebody who's buying a business to become, entrepreneurial business owner, but there's also existing businesses, especially in industries that are fragmented. There's opportunities for the existing business to, through acquisition, grow and reduce some of the competition in the marketplace. Are there any differences when a business is doing some kind of acquisition, strategic growth? Are there any differences between that versus when it's maybe it's the first time entrepreneur doing something?
I'm not sure I know what you're asking in this case. Maybe try rephrasing it. Maybe I'm just missing it.
Yeah, so let me rephrase it. So the scenario we're talking about now is an entrepreneurial acquisition where somebody is buying into a business to become, I would think the operator, the owner.
Yeah.
And so I'm doing a different scenario where there's an existing company that's doing acquisitions in their marketplace in order to grow strategically. I'm wondering, are there any differences between A and B?
Yeah. So I think it's usually a stage of development. So when businesses are first starting out, they're looking to make sure that their product gets acceptance in the marketplace. They're looking to make sure they can optimize profitability. Their goals are different when you're starting the business. I think of it as short term, midterm, and long term. Short term, if you're starting a business, it's, do you have a solid value proposition, and can you be successful in the marketplace? The midterm is more about, once you have customers, once you are making money, once you know that the business is running successfully, can you optimize that way to improve or increase profitability, either by increasing sales or cutting costs, or ideally both? And then when you get to a stage of sort of scaling up, really growing more rapidly, it's all about increasing the value of the business, increasing the assets that the strategic assets that the business might have, both intellectual property and otherwise, and
Mm-hmm.
maybe acquiring other businesses. So it's more of a roll up or scaling by looking at multiple businesses that complement the existing business you have. It's what we might call a satellite type of business that supports the core business, or by combining multiple businesses that are similar, that will increase the efficiencies and the size of the business and make them more attractive to other business owners.
Mm-hmm.
So I'm not sure I'm answering your question, but the way I think of it is, I think of it as different goals at different stages. And in the early stages, you're focusing on the viability, feasibility of the business, then profitability, and then really valuation,
Yeah.
increasing
Yeah.
the valuation.
Yeah, I can see like an early stage, first time entrepreneur buying into business. They want to make the business profitable. They want to make household income. And then as the business matures and maybe there's an acquisition strategy, then the bigger impact is the valuation of the business. So I can see some kind of life cycle thinking to that. What I know that you do work in the software and technology, different industries. Is that your sole area of focus, kind of the broadly speaking technology? If somebody has something, is that what they should come to you with?
Yes. So I've always been enamored of technology, and work with a lot of software and computer related companies, as well as semiconductor chip design company. So I tend to focus on those companies. They tend to have really smart people that build the products and uh, work in the industry, and that's where I spend most of my time. I'm currently working on a software company roll up where we're focused on custom software developers, and it's a good example of a fragmented market where there are pretty much any engineer who coded could open their own shop and say they design and develop software. Now they're getting a little more competition from AI tools, but still there are a lot of software developers out there, but they really don't have a dominant share of any particular market. So what we do is we look for companies that we can combine that, again, coming back to that, putting the pieces of the puzzle together, companies that we think have synergies in different areas of expertise, whether it's the technology or whether it's an industry vertical. And we try to put them together to create bigger companies that will then allow them to attract bigger customers.
Yeah. That makes a lot of sense. And I'm going to bring it up. Before, when we spoke, you're looking for certain talent to come into these businesses, right? So what type of people are you looking for that can execute on this type of plan?
As an acquisition entrepreneur, we're always looking for people who want to work in the business and take over businesses. So these are the operators, and anyone who's got experience in a particular industry or field can be attractive to taking over a software company. If you do software for real estate and you've got experience managing real estate businesses, then that's going to be helpful. So the operators are one type of talent that we look for. The other type of talent is really when we're acquiring businesses, we look for businesses that have talent within their field of expertise. So one of the companies I'm working with, they sell mostly to Fortune 1000 companies. They are selling systems or designing and architecting systems that might be, generating $1 million a year in engineering services. For those kind of companies, they need to have some talented developers in the fields of AI and the Internet of Things, IoT, can be blockchain, could be any of the software disciplines. Those kinds of talent we're often looking for a particular company.
Yes, that's good to know. I mean, people are coming to mind as we talk here. So what is a good way for a person to get in touch with you about this?
Best way is on LinkedIn. I can be easily found by the spelling of my name, which is just Roger Glovsky, and it's all together. You'll find me on LinkedIn.
That's great. We'll include the link to your LinkedIn in the description part of this podcast. So
great. Well, I'm always happy to meet new entrepreneurs, other professionals, talk about deals, share any of my knowledge, experiences. So I welcome people connecting with me.
Good. Roger, thank you so much for sharing this part of the journey, making us smarter about how to become an entrepreneur through acquisition. I mean, I can tell you that the other way is hard, right? Going to the market with a new idea, vision, seeing that the market adjusts differently. I mean, I think founder entrepreneurs will say that's, the first million's tough. To getting past the 5 million is something. Then it's, the sky's the limit from there, kind of thing. So thank you
That's
so much.
exactly right. And thank you for all you do, because having a growth CFO makes the job a lot easier when you're trying to grow a company quickly.
Yeah, you got to have the right people on the team. It makes so much difference. And so, all right. So with that, audience, thank you for your time and attention. Give me feedback. Let me know what else you want to see, and we'll do it. So thank you.